You have probably heard the California housing crash narrative 100 times already. Prices are supposed to collapse, foreclosures are supposed to surge, and headlines keep promising a dramatic reset. But what is actually happening in 2026 looks very different. This is not a headline crash. It is a payment problem quietly spreading through the suburbs that exploded during the era of cheap money. Mortgage rates are hovering near 6%, while millions of existing homeowners are locked into loans closer to 3%. That gap has frozen mobility, distorted supply, and shifted the entire market away from speed and emotion toward math and monthly survival. Homes are not disappearing in a weekend anymore. Listings are lingering, negotiations are back, and pressure is building first in the places that relied most on financing. Long commutes and optimistic stretch buying. Today we are breaking down the top 10 California neighborhoods showing the clearest signs of housing stress in 2026, not based on panic or headlines, but on rate sensitivity, financing dependence, inventory pressure, and rising ownership costs. Because before prices fall, behavior always changes first. And the first stop on this list might already feel familiar if you live there. Let's start at number 10. Number 10, Santa Clarita. Santa Clarita sits on the northern edge of Los Angeles County, and for years it marketed itself as the rational alternative to the city. More square footage, newer developments, a quieter environment within commuting distance of major employment centers. That formula worked extremely well when borrowing costs were historically low. As of January 2026, most and 30-year fixed mortgage rates are averaging around 6%, according to Freddie Mac's weekly survey. That is materially higher than the sub 3% loans many California buyers secured in 2020 and 2021. On a mid-range Santa Clarita home, the difference between a 3% loan and a 6% loan can translate into hundreds of dollars more per month. Over the course of a year, that becomes thousands in additional cash outflow. Santa Clarita is not a cash-dominated luxury market. It is largely dependent on finance buyers. State housing analysis shows that a large share of existing California homeowners still hold mortgage rates below 5%, which reinforces the lock-in effect and limits natural resale inventory. That means the buyers active in 2026 are facing the higher rate environment without the cushion earlier entrants enjoyed. Compared to peak pandemic era conditions, homes across many Southern California suburbs are taking longer to sell. When days on market extend, urgency fades. When urgency fades, negotiation power shifts. In commuter-reliant areas like Santa Clarita, the mortgage is only part of the calculation. Fuel, vehicle wear, insurance, and time all compound the real monthly burden. When buyers run that full stack at a 6% rate environment, qualification tightens and hesitation increases. Historically, payment-sensitive suburbs tend to adjust faster when borrowing costs remain elevated. In 2026, Santa Clarita fits that profile. Number 9. Palmdale. Palmdale has long functioned as the affordability release valve for Los Angeles County. When buyers were priced out of the San Fernando Valley and coastal corridors, they moved east. The trade was simple: longer distance in exchange for lower sticker price and more space. That equation worked when borrowing costs were historically cheap. As of January 2026, with 30-year mortgage rates averaging around 6% according to Freddie Mac, affordability is no longer defined by list price alone. It is defined by monthly payment. Palmdale is heavily mortgage dependent. This is a market driven by financed households, often first-time buyers or families stretching carefully into ownership. At a 6% rate environment, qualification thresholds tighten quickly. A buyer who could comfortably afford a payment at 3% may not clear underwriting at today's rates without scaling down expectations. That shift removes entire groups of marginal buyers from the pool. There is another layer in Palmdale. In many wildfire-exposed and exurban regions of California, insurance premiums have risen in recent years. According to state regulatory reporting, insurance does not show up in headline price comparisons. It shows up in escrow calculations. When buyers stack principal, interest, taxes, and rising insurance together, the total monthly number becomes the real decision point. Compared to peak pandemic-era speed, homes in many outer suburban markets are taking longer to move. When properties sit longer, leverage shifts toward buyers. And in payment-sensitive markets like Palmdale, once leverage shifts, pricing pressure follows. Historically, suburbs dependent on financed entry-level demand adjust faster under sustained higher borrowing costs. In 2026, Palmdale fits that profile clearly. Number 8. Eastvale. Eastvale represents the Inland Empire boom in physical form. Rows of of newer homes, master plan neighborhoods, rapid growth during the ultra-low rate years. That expansion phase was built on cheap financing. In January 2026, Freddie Mac's weekly survey places 30-year fixed mortgage rates near 6%. That level significantly tightens buyer qualification compared to the 3% era. Eastvale is not a cash-driven enclave. It relies heavily on financed households stretching carefully into ownership. When borrowing costs double from pandemic-era lows, the monthly obligation on the same property increases sharply. That shift alone shrinks the qualified buyer pool. But Eastvale faces a second pressure point: new construction competition. Industry reporting through 2025 and early 2026 shows builders in affordability-constrained markets offering rate buydowns and incentives to sustain demand. When a builder subsidizes a buyer's interest rate, the effective monthly payment drops immediately. Resale sellers cannot replicate that advantage without cutting price. In a city where much of the housing stock is similar in age and layout, competition becomes direct and measurable. Buyers compare nearly identical homes and choose based on payment efficiency. Compared to peak pandemic-era velocity, homes across multiple Inland Empire markets are taking longer to move. Thus, longer days on market reduce urgency. Reduced urgency increases negotiation leverage. Once incentives become common in new builds, comparable resale pricing adjusts transaction by transaction. Historically, payment-sensitive suburban markets with active construction pipelines respond faster when borrowing costs remain elevated. In 2026, Eastvale fits that profile precisely. Number 7. Menifee expanded rapidly during the years when affordability felt temporarily restored by cheap credit. It offered what coastal counties could not: bigger homes, newer subdivisions, noticeably lower sticker prices than Orange County or Los Angeles. But Menifee's vulnerability in 2026 is not identical to Eastvale's builder competition. It is dependency on outbound buyer flow. This market depends on a steady stream of households relocating from denser, more expensive regions. When that inflow slows, momentum fades quickly. Mortgage rates near 6% in early 2026 have materially reduced the number of buyers willing to trade proximity for space. The commute trade-off matters more now. Distance is no longer offset by ultra-cheap financing. Fuel, time, and daily logistics re-enter the equation. In exurban markets like Menifee, buyer psychology is heavily confidence-driven. When buyers believe appreciation is guaranteed, they stretch. When appreciation feels uncertain and borrowing costs remain elevated, they hesitate. That hesitation shows up first in offer behavior: lower initial bids, requests for credits, extended negotiation timelines. Menifee also has a concentration of similarly built homes from the same development cycles. In slower environments, that uniformity creates visible pricing tiers. The most motivated seller sets the benchmark. Subsequent sellers must adjust around it. Historically, outer ring suburbs dependent on migration from higher cost metros respond faster when buyer inflow contracts. In 2026, Menifee's exposure is not dramatic volatility. It is sensitivity to slowed migration and reduced stretch capacity. Number 6. Rancho Cucamonga. Rancho Cucamonga has long been viewed as a safe middle ground in Southern California. Not coastal luxury, not deep exurban risk. A suburb positioned between Los Angeles and the broader Inland Empire, with established neighborhoods and steady demand. But in 2026, even markets with reputations for stability are being tested by one central force: monthly payment pressure. At Rancho Cucamonga price levels, that rate environment produces a materially higher monthly obligation than buyers faced during the 3% era. This is not a cash-dominated market. Most transactions rely on financing. That makes the mortgage payment the deciding factor. When the payment crosses a psychological affordability line, demand doesn't gradually soften, it pauses. Compared to peak pandemic-era conditions, homes across many Southern California suburbs are taking longer to sell. When listings linger, the tone of the market shifts. Sellers begin pricing according to older comparable sales. Buyers negotiate based on current borrowing costs. That gap widens. Rancho Cucamonga also faces regional competition. Buyers comparing options can look toward nearby markets with lower entry prices for similar square footage. When substitutes exist within driving distance, premium pricing becomes harder to defend. Once one motivated seller reduces to secure a deal, comparable sales begin resetting. Appraisals tighten, negotiations become more aggressive. Rancho Cucamonga's exposure in 2026 is not dramatic oversupply. It is the compression that happens when a mortgage-reliant mid-tier suburb meets sustained higher borrowing costs. Number 5. Chula Vista. Chula Vista has long been positioned as the attainable side of San Diego County, close enough to job centers, large enough to offer real neighborhoods and newer developments. For years, it carried the reputation of being the practical alternative to higher-priced coastal markets. But in 2026, affordability is no longer defined by reputation. It is defined by total monthly burden. As of January 2026, 30-year fixed mortgage rates remain near 6%, according to Freddie Mac. At San Diego County price levels, that rate environment produces a materially higher monthly payment than buyers face during the ultra-low rate period. Chula Vista is primarily a finance buyer market. That means the mortgage payment determines activity, but here the mortgage is only part of the equation. Many communities include HOA dues. Some carry additional assessments tied to development phases. Insurance costs across California have trended higher in recent years, particularly in regions exposed to wildfire and climate-related risk. When buyers calculate principal, interest, taxes, insurance, and HOA together, the total monthly figure can exceed comfort quickly. Compared to peak pandemic-era velocity, homes in many Southern California suburbs are taking longer to sell. When listings remain active longer, buyers gain leverage. Open houses feel quieter. Offers become more conditional. Credits and concessions reappear. Chula Vista also faces internal competition. Buyers evaluating the area can compare neighboring communities within Southern San Diego County, looking for small price differences that translate into meaningful monthly savings at a 6% rate. When alternatives exist, pricing power tightens. If one motivated seller adjusts downward to close, nearby comparable values begin resetting. Chula Vista's exposure in 2026 is not lack of demand interest. It is payment compression in a market where the all-in monthly number is becoming harder to carry. Number 4. Irvine has long been treated as one of California's housing fortresses. Top-rated schools, master-planned communities, close proximity to major employment centers in Orange County. For years, many buyers assumed demand here would remain structurally insulated, but in 2026, even Irvine is not insulated from rate sensitivity. At Irvine price levels, small shifts in interest rates translate into substantial monthly payment differences. On higher priced homes, even a 1% rate change can mean hundreds of dollars per month. Compared to the 3% financing environment of 2020 and 2021, today's borrowing costs materially compress affordability. Irvine is not purely a cash market. While it attracts higher income buyers, a significant portion of transactions still depend on financing. That makes the monthly obligation decisive. Another structural factor in Irvine is housing type concentration. The city contains a large number of condos and townhomes clustered within similar price bands. When multiple comparable units list simultaneously, competition becomes direct. Buyers compare nearly identical properties and focus on payment efficiency. If one seller offers credits or adjusts pricing, nearby listings feel immediate pressure. Industry reporting through 2025 and early 2026 shows builders in affordability-constrained markets using incentives and rate buydowns to stimulate demand. When new construction competes in overlapping price ranges, resale sellers must respond. Compared to peak pandemic-era speed, many California suburban markets are seeing longer listing durations. When homes remain active longer in a market once defined by urgency, psychology shifts. Buyers negotiate more aggressively. Sellers lose automatic leverage. Irvine's exposure in 2026 is not instability. It is heightened rate sensitivity in a high-price market where monthly payment math now overrides reputation. Number 3, Daly City. Daly City has long operated as a pressure valve for San Francisco pricing. Close enough to the urban core to maintain demand, historically more attainable than many Central Bay Area neighborhoods. For years, that proximity supported steady buyer activity, but in 2026, proximity alone does not override payment pressure. In high-price regions like the Bay Area, even modest rate increases produce large monthly payment swings. On a median-priced home, the difference between 3% and 6% financing can add well over $1,000 per month. That materially reduces the number of qualified buyers. Daly City is not immune to financing constraints. While it attracts stable demand, a substantial portion of purchases still rely on mortgages. That makes borrowing costs central to market behavior. Another factor in Daly City is housing age. Much of the inventory consists of older homes. In a fast-moving market, buyers may overlook deferred maintenance. In a slower market, they price it in. Roof age, drainage, foundation work, electrical upgrades. These become negotiation points rather than afterthoughts. Compared to peak pandemic-era conditions, many California markets are experiencing longer listing durations. When homes sit longer, as buyer scrutiny increases, inspection contingencies regain weight, credits return to negotiations. There is also rising awareness of insurance exposure in coastal and climate-sensitive regions across California. When insurance costs increase or underwriting tightens, buyers factor that into long-term ownership calculations. Daly City's exposure in 2026 is not lack of demand interest. It is the combination of high rate sensitivity, aging housing stock, and reduced urgency in a market where financing costs now carry more weight than momentum. Number 2. Brentwood represents the modern Bay Area trade-off. More space, newer subdivisions, lower entry prices than core Silicon Valley or San Francisco. During the ultra-low rate era, that trade looked attractive. Cheap financing offset longer commutes. In 2026, that equation is under pressure. In a mortgage-reliant suburb like Brentwood, that rate environment materially tightens qualification. A buyer who could comfortably stretch in 2021 may no longer qualify at today's borrowing costs without reducing purchase price. Brentwood depends heavily on financed families relocating from higher cost Bay Area counties. When borrowing costs rise, that inflow slows, and when inflow slows, inventory competition increases. Brentwood also contains large clusters of similarly built homes developed during the same growth cycles. In a slower market, uniform inventory creates direct pricing comparisons. Buyers evaluate nearly identical properties and select the most financially efficient option. If one motivated seller reduces price to secure a deal, nearby listings must respond. That is how comparable sales reset. Commute trade-offs also matter more in 2026. When mortgage payments rise, buyers become less willing to absorb long-distance travel costs on top of housing expenses. Fuel, time, and daily logistics regain weight in the decision process. Compared to peak pandemic-era transaction speed, many California suburban markets are experiencing longer listing durations. When homes sit longer, urgency fades. When urgency fades, leverage shifts. Brentwood's exposure in 2026 is structural. It sits at the intersection of mortgage sensitivity, migration-dependent demand, and highly comparable inventory. In a sustained higher rate environment, those factors amplify adjustment pressure. Number 1. Temecula tops this list because it combines multiple structural pressure points at once. It expanded aggressively during the ultra-low rate years. It attracts primarily finance buyers rather than cash-heavy investors, and it depends on distance trade-offs to justify value. When mortgage rates were near 3%, that model felt sustainable. In January 2026, with 30-year fixed rates hovering near 6% according to Freddie Mac, the monthly obligation on a typical Temecula home is materially higher than it was just a few years ago. That shift directly reduces purchasing power. Temecula's growth was fueled by households relocating from more expensive Southern California counties in search of larger homes and newer communities. That migration flow is highly rate sensitive. When borrowing costs remain elevated, fewer buyers are willing or able to stretch into longer commutes and higher total monthly expenses. Temecula also contains extensive clusters of similarly built homes developed within the same time frame. In slower markets, that similarity creates transparent price competition. Buyers compare nearly identical properties and select the one with the strongest financial terms. If one seller offers a price reduction or credit to secure a contract, nearby comparable values adjust accordingly. Industry reporting through 2025 and early 2026 indicates that builders in affordability-constrained regions are increasingly using incentives and rate buydowns to sustain activity. When new construction competes directly with resale inventory, pricing pressure intensifies. Compared to peak pandemic-era transaction speed, many Southern California suburban markets are experiencing longer listing durations. When homes sit longer, negotiation becomes the norm rather than the exception. Temecula's exposure in 2026 is not sudden collapse. It is cumulative pressure, higher borrowing costs, migration sensitivity, comparable inventory competition, builder incentives. When those forces overlap in a mortgage-reliant market, adjustment risk increases. That combination places Temecula at the top of this list in 2026. The pattern unfolding across these suburbs in 2026 does not resemble the dramatic collapse many people imagine when they hear the word crash. Instead, it reflects a structural shift driven by sustained higher borrowing costs, constrained mobility caused by the lock-in effect, and a buyer base that now evaluates homes primarily through the lens of total monthly burden rather than emotional momentum. As long as 30-year mortgage rates remain materially above the ultra-low levels of 2020 and 2021, payment-sensitive markets are likely to experience pressure before cash-dominated or ultra-luxury segments. Longer days on market, renewed negotiations, selective price reductions, and expanding concessions are not random events, but consistent signals of leverage gradually shifting from sellers toward buyers. The defining question in 2026 is no longer whether a neighborhood carries strong schools, newer construction, or brand recognition, but whether the full cost of ownership can be sustained comfortably over time in a higher rate environment.